This tutorial video looks at the concept of net trade. Well, net trade is also known as the trade balance, and it's the difference between the value of a country's exports and the value of a country's imports of goods and services over a specific time period, for example, 1 year. So net trade is the value of exports, or X, minus the value of imports, M. So the net trade balance is X minus M, and you will have come across that in the equation for aggregate demand. AD equals C plus I plus G plus X minus M. A positive net trade balance is called a trade surplus, and it adds to a country's GDP. It indicates the country is producing more than it's consuming from foreign markets, and a positive trade balance can stimulate economic growth. A trade deficit means the value of imports is greater than the value of exports, and that can have significant effects. It can mean fewer job opportunities in export-related sectors, as domestic producers might be losing market share to foreign competition. Sustained trade deficits can lead to a country to have to borrow from other nations to finance the gap, and that can lead to increasing foreign or external debt. So here is a couple of examples. First of all, China. China's trade surplus runs into hundreds of billions of US dollars each year and is a significant net injection into their circular flow. In the contrast, the United Kingdom runs a persistent trade deficit. The green line here shows the value of total exports per quarter. The blue line shows the value of total imports, and the histogram suggests and shows that the UK economy is running a trade deficit. These are the countries in the world with the biggest trade surpluses in 2023, measured in US dollars. China came top, Germany second, Russia, and then countries such as Saudi Arabia, Netherlands, Brazil and Australia. So these are countries that typically year in, year out, run very large trade surpluses, often based on significant manufacturing export sectors and also exports of natural resources such as oil and gas. These are the countries running the biggest trade deficit, and the United States is far and away, in terms of dollars at least, a trade deficit of $1.15 trillion in 2023. And the UK came second, and India came third with a $240 billion deficit. Other examples include countries like Turkey, Japan, Spain, Greece, and Mexico. Well, one way of measuring trade is to measure it in dollars. A second approach is to say, well, what's the size or scale of the deficit as a share of GDP? And that provides valuable context by showing how significant a country's trade balance is relative to the overall size of their economy. So expressing net trade as a share of GDP, I think, helps for more accurate comparisons between countries of different sizes and different economic structures. A highly positive percentage, Germany, for example, or Singapore or Norway, indicates a strong reliance on net exports for economic growth. South Korea, for example, is a highly strongly export-dependent economy. Whereas a high negative percentage suggests a country might have a very high propensity to import and potentially significant trade imbalances, particularly for countries with persistent trade deficits. And a good example to finish off is that of India. Now, we know that India has one of the highest trade deficits in the world measured in dollars, but it's also a sizable economy. And this chart reinforces this point. In each year since 2015, they've run a deficit on their trade balance, and that deficit's really never been lower than 4% of their economy. So India is running a very strong and large trade deficit. There we go, a quick primer on the meaning of the term net trade.